Greetings and welcome. I'm Dr. Denver, and thanks for checking out my second presentation on basic accounting in alignment with the chapters in my book, Accounting 101, Easy Accounting and Bookkeeping for Beginners. This session is about concepts presented in Chapter 1, the must-read overview of accounting and bookkeeping. We will be discussing some fundamental accounting activities and concepts such as a business entity, business transactions, cash and non-cash transactions, the double entry system, and most important, the accounting equation. A business entity is a firm or organization formed to generate some income or profit or some other specified objectives by operating activities of the firm. Examples include sole proprietorships, partnerships, limited liability corporations, S corporations, and C corporations registered with the Secretary of State. Four popular types of business entities are 1. Generalized merchandising firms such as retailers and wholesalers. 2. Service firms. 3. Manufacturing firms. And 4. Hybrid manufacturing and trading firms. Business transactions are transactions completed on behalf of a business entity and is usually evidenced by a receipt of product or an invoice showing the exchange. Note, personal transactions are not recorded in the firm's accounting records. Cash transactions are business transactions completed through the immediate payment or receipt of cash by the firm. Non-cash or transaction on credit involves settling business transactions at a future date or payments on terms. Two main fundamental concepts in bookkeeping are the double entry concept of accounting and the accounting equation. The double entry concept of accounting, which is universally used in most accounting and bookkeeping activities, requires that business transactions consist of both debits and equal amount of credits for each business transaction. The recording of the transaction is based on the chart of accounts. In other words, using the chart of accounts, the bookkeeper shows that every transaction has an equal movement of value to debit and a receiving general ledger account, and one from a credit or a general ledger which is credited with the equal amounts to ensure the double entry concept and that the transaction is in balance. Ledger accounts are used to record business transactions according to the chart of accounts, indicating the origin and allocation of valuable monetary resources. The accounting equation is based on the same double entry system of accounting used for recording transactions in the journal and provides a summary of all amounts posted in general ledger accounts in a simple formula. Total assets, A, is equal to the sum total of liabilities, L, plus owner's equity. In other words, or A is equal to L plus E. Tangible and intangible economic resources owned by a business are its assets. The amounts owed to creditors are debts or liabilities. The amount of assets remaining after deducting liabilities and controlled by owners and investors in a business are called owner's equity, or the net value of the business. General ledger accounts for assets usually have debit balances, and the ledger accounts for liabilities and owner's equity or capital normally have credit balances. Hence, it is called the equation, an accounting equation, because of the double entry system of accounting concept in the previous section, where total of the accounts with debit balances must equal the total of the accounts with credit balances. The equation is the basis for a firm's balance sheet at a specific date. A quick look at any balance sheet will show different asset classes and total assets amount, and another section showing classes of liabilities and equities, followed by a combined total liabilities and equity amount, and the two sections total amounts must be equal. Thanks for watching this presentation.